I actually bought this T-shirt back in 1996. So they obviously people found this idea to be sort of an interesting one. It's not affiliated with Mr. Internet Bubble. If I pop, you're screwed. And there's a free balloon mortgage inside. So I want to go in a completely different direction than Paul and Andrew did. I will also say that this is joint work with Alex Chinko, who's a PhD student at NYU and used to work for me here at the business school. I want to actually swap to a picture for a second, and just so you get a sense, this is a Google Earth map of Las Vegas. And what's particularly interesting, and we could sort of pull back further if we wanted to, but I sort of thought there was enough sort of areas. One of the things sort of interesting in Las Vegas, you've kind of landed at McCarran sort of airport, is you're kind of coming into Las Vegas, the wheels go down, and you're looking over a complete flat desert. There's nothing there. And you look around, and as the plane gets closer and closer to the ground, all of a sudden you see some houses, and basically you land on the ground. And that's somewhat different than other places that you fly into, where as the wheels go down, you see a lot of houses around and other things, or you see places that are, coming into San Francisco, you're coming in over the bay. In Boston, the same thing. There's lots of stuff around. What's sort of enormously interesting about Las Vegas is there's no stuff around. In fact, if we wanted to double the size of Las Vegas tomorrow, we actually could do it. It would be no problem whatsoever, just continuing to go up I-15 further in either direction. There's some mountains out here, but basically Enterprise, we could sort of go up. There's lots of infill areas over here, plenty of room to build. So one of the sort of striking things about trying to understand the housing bubble and to trying to understand what happened was that we managed to produce a housing bubble in a place where land is seemingly free and easily available. And that's kind of a striking fact when one sort of thinks about, how we think about bubbles and how we think about, the pricing of assets. And it's a challenge that I think is a challenge, and this is where kind of the link to the internet is kind of interesting, because you could sort of think of the internet as something where there was a lot of available supply. It was pretty easy to build an internet company, and we all know Pets.com, Webvan actually did something. It actually had a physical presence out in San Francisco, but you could all name your favorite internet company. But people built a lot of them pretty quickly before the internet bubble finally collapsed. What I want to talk a little bit is just to kind of put up some facts that will, along with the picture of Las Vegas, hopefully give one a different impression of the housing cycle and the housing bubble that we've been through than maybe what one would read in the papers. The first is that there was just an unprecedented rise in house prices, but we particularly saw places like Miami and Las Vegas hitting annual growth rates of 30% or more between 2003 and 2006. But it wasn't just in the United States. Anybody who looked around the world, particularly in Europe, would have seen many of the same phenomena. So if we want to look at some pictures, if I covered this up and asked you which was the US, you could probably see now. US is in blue here. What's sort of interesting is, for all the housing bubble concerns about the United States, if you look at a map with Europe, the United States does not seem particularly unique relative to other countries in Europe. And in fact, if we kind of look, Ireland took the next hit, the UK took a hit, and believe it or not, Spain doesn't look like it's fallen that much, although some of this has, some of what happened here has as much to do with the foreclosure and bankruptcy systems in the US and Europe as it actually does the housing markets themselves, which is to say, when you miss your payments in the United States, banks immediately move to take away your home. When you miss your payments in Europe, banks are less concerned because you can't hand the keys over to the bank. They will actually garnish your wages for 50 years if needed for you to pay off your mortgage. So banks are a little less concerned, and people actually miss fewer payments with the view that you can't just go into a courtroom, or in some cases just literally put your keys in the mail and send them back to the bank. So part of the collapse here represents as much about what happened in other parts of the economy, or sort of other legal issues, as it does. But on the run up, which is a big thing, first fact, US wasn't alone. The second fact is that markets looked very different within the United States. So if you look, for example, at New York, these are not on the log scale. If I did them on a log scale or percentage scale, the second bump wouldn't look as big relative to the first bump. But one of the things that's interesting is New York now doesn't really look like it had much of a bubble relative to the 1980s. Boston, the same thing. But in some of the western areas, particularly the coastal markets, particularly Los Angeles and especially San Diego, to a lesser extent DC, the humps here are bigger than the humps here. But these are markets where every decade prices tend to be higher than the decade before, and there's a strong upward trend in prices. Compare this to places where I presume relatively few of you live, and relatively few academics, and very few people who are kind of among people who kind of do analysis of housing markets, but actually where the bulk of Americans live, which is in the Midwest and South, where you'll see, and I don't have Houston on here mostly because Houston is the fourth largest city in the country. It's approaching, it's growing at a very, very rapid rate. But house prices in these markets have basically been flat. There was a little bit of a hump here, but not enormously so. And prices have been more or less stable. Again, there's variation within these markets, but these markets, we didn't see a big run-up, nor did we see a real collapse in house prices. Detroit being the exception, is just the bottom fell out of the Detroit economy. You could actually argue there was a bubble in house prices in Detroit in the sense that prices shouldn't have been going up at all, and maybe should have been on a downward paths if we could sort of run a counterfactual for Detroit. These are kind of, to me, as sort of somebody who studies bubbles, the most interesting markets, because these are markets which have had very high growth rate of population, but historically, no run-up whatsoever. Las Vegas, again, really interesting. From 1970 to 2000, Las Vegas grew from 150,000 to 1.5 million people, tenfold in population. That same time, that same 30-year period, real house prices in Las Vegas after inflation grew something less than 10%, cumulatively, the whole time period. Houston, over the same time period, added 2.2 million people to the metropolitan area of Houston, and real house prices in Houston didn't rise at all. So these are markets which have had huge growth of population, but up until the early 2000s, had never seen appreciable price appreciation. And all of a sudden, in one fell swoop, Phoenix very much the same, prices just doubled. These are all real, so you can sort of, if you get rid of some of the indexing, prices just literally almost doubled in a 3-year period, coming almost out of nowhere. And so when one thinks about bubbles, what I'm trying to understand is these markets right here. How do we get these kind of price spikes seemingly out of nowhere, which look to me different than here or here? Now, people have talked about a number of things. I've written on some of these subjects. I believe that some of these things matter. So falling mortgage rates, Dean Hubbard and I wrote a paper, actually a couple of papers, which have looked at the impact of mortgage rates on housing prices. Whatever that impact is, there's just no way you get Las Vegas going like that. So this is not a story about falling mortgage rates, rising mortgage rates, or global imbalances around the world. The second, subprime loans. What's wrong with the subprime loan explanation? How do we end up with, one, subprime loans were available in all of these places in the US, and certainly the fact that we saw it in Spain, in Ireland, in the UK, they didn't do subprime loans there. In fact, Spanish loans are almost all 20% down bank financed debt. by banks that at least so far have managed to succeed, although again, one wonders how good their balance sheets are. So subprime lending, securitization, no skin in the game, all those kinds of explanations may well have led to the failed financial system, may well have led our over-leverage in our financial system to collapse. Those are no small problems. But it's unclear that they were the predominant cause of the housing bubble. We're going to focus on this third thing, which is sort of the role of speculators and how people kind of set expectations and think about buying in markets. But that's always going to be subject to the question of why did this happen in some places and not others? What is it about the places that happened and the places that didn't, so that we can have some kind of coherent explanation for what that is? And we're going to at least have some theory on this. So what do? Well, we're going to try and use some, I think, very interesting data to identify a group of speculators, who in this case are out-of-town buyers, who we posit whose value of a house is lower than the net value of a house for people who are in that market. There are two reasons for that. One of them is if you're not living in a house, inherently you either face a tax cost, that is you don't get to deduct mortgage, actually you get to deduct some interest payments, but you have to pay taxes on that house as an investment asset. The second is that because you're not living in it, somebody else has to maintain it, and that's also costly. And if you're out of town in particular, it's actually hard to even do that. And if you're living in it as a vacation home, you're not using it all the time. So your value of that asset is somewhat lower than the value of the asset for people who are living in that house or people who are even living in the same town as investors. They're sort of interesting because these are also a group of people who are somewhat less well informed about potentially less informed about what's going on in a market. We're going to use a real interesting data set which we can track the address that the property tax bill is sent to for people who buy homes in 11 metropolitan areas from 2000 to 2008. We use 10. We throw out New York for the New York data has a little bit of an issue with it at the moment. And so we're using that to help identify speculators, and we're going to have two different kinds of speculators here. One of them are going to be local speculators who live in the same metropolitan area. The second are going to be out-of-town speculators. And eventually we're going to be able to look at subprime loans and credit reports and other really fun stuff. The second thing, of course, is to try and determine a direction of price impact. So one of the things is, do speculators invest because they think prices are going to be rising? Or when speculators invest, do they actually cause prices to rise? And one has to worry a lot about that causality of why people moved into one market or another. What we're going to argue is that we have a way of potentially identifying this by looking at differences in the size of markets, and I'll explain this in a little more detail in a second. And what we're going to show is that the increased presence of out-of-town but not local speculators is associated with higher rates of subsequent price appreciation and also a higher ratio of price to rents. And we're going to show you that these out-of-town speculators actually get lower returns. And I'll talk at the end about other places where this might apply. There's a large literature on bubbles in academia, none of which focuses on this particular kind of issue. The closest we come to some of this literature is a literature which finds that people are more likely to invest in local markets, something called the home bias, relative to investing in foreign markets. And in particular, people even find that if you're in a region of the country, you're more likely to invest in the utility in your region of the country than in other places. But what's interesting is these home-biased investors tend to get somewhat better returns than non-home biased investors. So it suggests there may be some kind of information available to them that's not available to other people. This is going to put at least somewhat additional evidence on that. We define a speculator, as I talked about before, as somebody who lives in a different place. There could be multiple reasons for speculating. One of them might be, to buy and, to maintain a house. Another is to rent it. Third is to just flip it. And we think that speculators sort of have higher costs of ownership and disadvantageous tax treatment. This is kind of the data that's the heart of the paper. What's sort of interesting here, and here you may be able to see the scale, but I'll kind of point it out to you. This is the percentage on a monthly basis of all homes in a market that were purchased by out-of-town buyers in a particular month. Now, if you look at the data in Las Vegas during the peak months of 04, 05, what you found is 0.2% of houses in a month, meaning 1.2% of all the houses in a year, a little more than that, in a market were purchased by out-of-town buyers. Given that on the order of kind of 5% of houses turnover, that says, you know, about 20%, maybe a little more than 20%, sorry, a little less than 20% of the houses that we're turning over for out-of-town buyers. If you look at Denver, by contrast, move the decimal point over one place. So instead of 0.2, it's 0.02. So while we saw a similar kind of pattern, the percentage of the market in Denver that represents out-of-town buyers is much lower. Miami is about a third the size of Vegas, but still very substantial. And Phoenix is 2/3 of the size of Vegas in terms of the size of this. San Diego is about 1/15 the size of these other markets. So on a percentage of the properties in the market, you see that there are a lot of out-of-town purchasers coming in during the peak of the market. That said, one of the first things we can do is just kind of do a simple regression, and we do this in what's called a vector auto regression, but I'm not going to show you all the pieces. It's going to look at the relevant parts for this. Just the first thing is to show you that price changes in a year are partly correlated with past price changes. That's well known in the literature. There's kind of momentum in house prices. Are very highly correlated with the percentage of out-of-town investors in a market, basically completely uncorrelated with the percentage of local investors. Note that the third category is excluded is a percentage of owner occupants. So if you kind of remember statistics and regression analysis, basically you can't put in dummy variables for all groups, you have to exclude a group. So think of this as the relative effect compared to owner occupants in a market. So owner occupants and local investors appear to have little effect on or are uncorrelated with future price changes, but out-of-town investors are positively correlated with out-of-town price changes. The results are in fact even stronger if what we do is we look at sort of the relative cost of owning to renting, or think of this as kind of the price to rent ratio. So in other words, this is something not just about prices rising, but it's about kind of the overall affordability or pricing in a market. And so in this case, the price to rent ratio turns out to be very highly correlated with out-of-town investors. So they're actually bumping up prices relative to rents in markets, or at least they're correlated with subsequent rises in prices relative to rents. So how do we think about causality here? Well, this is one of the sort of interesting pieces of this, kind of putting it together for us, is to point out that these circles are roughly correlated with the size of each of these markets. So imagine there are a group of investors who are kind of going into different places. Well, in what place? Suppose that a bunch of people from Los Angeles decided to invest. Some of them like Las Vegas and some of them like San Francisco. Well, knowing nothing else but size, as it turns out, since San Francisco is twice as large as Las Vegas in terms of the number of single-family homes, the impact of people coming from Los Angeles is a lot less in San Francisco than it's going to be in Las Vegas. And certainly in order to sort of drive prices up in Los Angeles, you've got to have a lot of people from a lot of places pushing up prices. And so the idea that the size of the market plays a role in bubbles at least seems intuitively apparent. And one of the things we do now is we actually can show that those price increases are directly correlated with the percentage flows from markets. So if you look at the percentage of people that go from Los Angeles to San Francisco and back to Los Angeles and to Las Vegas and back to Los Angeles and to the other 7 markets in our area, if you look at those flows and you interact the relative size of the markets that they're coming from relative to they're going to, what you find is that those flows themselves are correlated with changes in prices in exactly the way that this effect would suggest. And so what we find is that a 1% increase in investors going from a large city to a small city has a much bigger impact on prices when that city is large relative to the city they're going to, and vice versa. And so it's not just a correlation, between investors coming from one market to another, the correlation is proportionate to the relative size of the markets, which suggests, in fact, a quantity effect of driving prices, not just a correlation between market A and market B's prices. So the size matters in this. One other thing, which kind of completes the circle, or at least completes where we're headed with this so far, is how do the out-of-town investors do? Well, as it turns out, the out-of-town investors do kind of crappy. How do we know this? Well, these lines right here, the height of these lines represent the density of purchases, or the bulk of purchases. And what you see is that these guys come into the market at exactly the time when returns to buying are low and negative. And so the people coming in essence, come in at exactly the time when their returns ex post turned out to be very low. That is, they're buying at sort of disproportionately overpriced times. And they're stuck with houses that turn out to be worth a lot less than they had hoped. How does this relate to the bubbles literature? I think I have two more slides to finish. I mean, one of the things is people have often tied a link to supply and bubbles, and as it turns out, I think it's a little bit more sophisticated a link than that. Particularly, these all tend to be relatively small markets compared to the size of the overall housing market. This suggests less informed investors do worse than other investors, and I'll show you in a second a number of other examples of this in the literature. How the people who point to inexperienced homeowners being stuck, as it turns out, the seemingly inexperienced homeowners actually do better than the out-of-town investors perform in the data. And if you thought that it was irrational exuberance of people living in a market getting caught up in prices, that's at least not explaining the extreme events for what's going on. The extreme events seem to be actually people coming from the outside driving up prices, as opposed to people from inside the market driving up prices. And it certainly helps explain why high price appreciation might have come in some places rather than others. The great way to think about this is, why did we have a bubble in Las Vegas, but we didn't have a bubble during the tech boom in San Francisco, which would have been another time that you could have really got carried away with prices? And the answer is the San Francisco market is a lot bigger, particularly if we include San Jose and Oakland. And it's a lot harder for outside investors to come in and drive up those prices, even if the story was equally compelling. It's a bigger market, and there's a lot more going on to do it. So the key features of this model, if you want to think about investing more broadly, local knowledge of expertise are important. And in segmented markets, one wants to be particularly concerned about smaller markets being prone to foreign buyers. So I lied, I have one more slide. So if we think about other kinds of examples for this, consumer purchases of .com or biotech stocks. So it's sectors of the market where we tend to see the kind of extreme mispricing as opposed to the overall market. And again, the idea that you may have less informed investors coming in from the outside driving up prices. The same methodology, by the way, could be applied if you look, for example, at investments by mutual fund managers and things that they know and things that they don't know, and look and see whether those flows appear to be causal in the same ways that we find in housing. European buyers of homes in Spain, same sort of idea. People who study commercial real estate. Again, Japanese investors did really, really badly in the United States. You may say, well, New York's really big. It wasn't compared to Japan at that time in terms of the overall market. The Japanese investors tended to concentrate in a small number of places, and those small number of places they concentrated had particularly poor returns. So I will stop there.